Everyone wants a better win rate, bigger winning trades, and more consistent trading results. But the answer is not finding a new trading strategy that might be better. It is learning how to level up the trading strategy you already have. After 16 years of trading myself and analyzing thousands of trades from all different traders around the world through Edgewonk, I have seen what separates losing traders from profitable ones. What surprised me the most? The path from losing to profitable to super profitable is almost always the same, and it's predictable and it's repeatable. In this video, I show you the exact process to evolve your trading strategy and unlock your true potential as a trader. When it comes to improving your trading performance, you have a few options. You want to focus on how to get bigger winning trades and improve your reward to risk ratio. We can analyze on how to get a more advanced risk management approach. We can start looking at how to improve our trading strategy as a whole with all the different components. And of course, we want to get our win rate up. So the first thing we always focus on when we're working with traders in Edgewonk, and the most important thing in the beginning when you're starting out when it comes to improving and tweaking your strategy, is finding out how you can get your win rate up. And of course, the first thing that we always do is help traders get fewer bad trades. That's where it really starts, and that's where you can see a lot of progress early on. Of course, how do you get your win rate up? Is just have more good trades and fewer bad trades. This is mostly easier said than done, but it's always the first starting point. You look at your last 30, 40, 50, 60 trades, however many you have in your database, and you want to analyze how many of those trades, where did I follow my rules 100%, and on how many trades did I break my trading rules. The trades where you broke your trading rules, most often those are the bad trades that drag your win rate down. So when it comes to improving your win rate, the answer is never finding a better system that just naturally has a higher win rate, because you are always going to be the weakest link in your whole trading process. So working on having fewer bad trades is really the first step always. So ask yourself, do you take random trades? Go through your last 20, 30, 40 trades, however many you have, and just look at how many of those trades, where did you break your rules and how do they perform. I'm willing to bet that most of the time when you take trades that are not in line with your trading system, can be revenge trading, it can be just impatience, it can be FOMO. I'm willing to bet that most of the time those trades lead to a poor performance and those trades fail more often. So it's really important that you are aware of that. The awareness is always the first step. And we've worked with some traders where they were fascinated and they were really surprised to see that if they would eliminate the trades where they trade outside of the trading rules, the performance from them would suddenly skyrocket. And we have seen even traders who are currently losing traders, but if they would have been able to just avoid some or most of the trades where they broke their trading rules, they suddenly would have been profitable traders. And this can be a really big aha moment once you realize, my system is actually not the problem here. My system is not inherently a losing system, but the trades that I take outside of my rules, that's the problem. Once you realize that, we've often seen that those traders can see a significant boost in performance and suddenly they are way more confident. Again, following your trading rules. And what we recommend here is to go through your last 20 to 30 trades and really look at what do the best trades have in common, what do the worst trades have in common. Even putting it into a checklist can help, so that before you pull the trigger on your next trade, you go through your checklist and you ask yourself, is this trade really a trade I should be taking, or am I missing some of the important criteria? You want to find more good trades obviously as well, so you want to leverage your strengths and the strength of your system. So analyzing and going through your last 30, 40, 50 trades and analyzing, where's the bulk of your edge? What do my winners have in common? What is my best performing setup? And where's the bulk of your edge? This can come in many different ways. What we have seen is that when traders trade different time frames, so we've been working with a trader who trades higher and lower time frames at the same time, the trades that he is taking on the higher time frame are not working out. And his trades on the lower time frame are performing really well. And if the trader would just focus on his strength, which is the lower time frame, his performance would change significantly. It could also be trading times. So maybe you're trading better and most of your money is coming from trading around the open. We have worked with hundreds of traders and we have seen so many times that trading times really do matter. A lot of traders make almost all of their money around the open because that's when the market moves the most. And it doesn't matter if you trade Forex, crypto, stocks, futures. Typically, there is a very big correlation between profitable trades and the trade time. So make sure to analyze that as well. And I'm willing to bet that a lot of you will also see that trading times really do matter. But also focusing on your best performing setups is obviously very important. We have seen a lot of traders that trade way too many setups. They have a lot of inconsistencies, and that brings us and brings me to the next point. You need better processes. So trade fewer setups, not only identifying which setups perform best, but also trading fewer setups. If you're a trader who's currently struggling, you're maybe not having the performance that you want to have, but at the same time, you're trading 8, 9, 10, or even more setups, I would recommend, and we have seen this so often, you should trade fewer setups. Focus on your 2, 3, maximum 4 best performing setups that are already making money, that you feel comfortable with. And I'm willing to bet that everything in your trading will change. Your process will be much better. You need way less time. There will also be less confusion when you have conflicting results. Your scanning routine will be better and more streamlined. And that's a huge part as well when it comes to just improving your trading quality as a whole. Limiting your trading hours, that's what I said here. Where's the bulk of your edge? And then really are disciplined. If you see that your best performing time of the day is around the New York Open and 2 to 3 hours after that, only trade during those times. And you will see over the next few weeks that you will probably feel much better. You have way more time for other things, and your trading will just improve and the processes will be much easier. Better trading routine to improve consistency is obviously very important. A lot of traders that are struggling also have very bad routines, or they have maybe never even thought about their trading routine. So really know when you're doing your chart prep work, when you're coming to your computer, what are you doing and when you're doing it. So if you're trading the New York Open and the 2 or 3 hours after that, come 1 hour before the trading time starts, mark up your charts, update your levels, scan the markets, find the best movers, and then after you've been done trading, make sure all of your trades are journaled, you record your thoughts, and that is going to help you improve your processes. And during those routines that you have improved, you will also start noticing things in your trading, things that are working, things that are not working. And overall, you will be able to improve your quality of your trading. And this will all contribute to having a higher win rate. So the next thing after a trader has worked on their win rate, the next thing we typically go through is how do you get bigger winning trades and how do you improve your reward to risk ratio? And of course, you also have a few options here. So full TPs and working on your targets is really important. And typically what we're seeing is that the first big problem is taking bad trades and breaking the trading rules. But once a trader has fixed that, the next area where there's a lot of room for improvement, and there's a lot of potential that a trader is missing out on, is looking at how do you deal with your trades when they are on. A lot of traders focus all of their time and energy on the entry, but they neglect the rest. And one of the most important things is analyzing, is price reaching your targets and are you closing profitable trades too early? This is the second biggest issue that traders that are struggling have. So in Edgewonk, obviously it's super easy and we are aware that this is a problem. So we built in mechanisms, tools and features to help you analyze if you're leaving money on the table. We look at your trades, we look at where you exit your trades, and then we tell you, was this the optimal exit or not? And once you see this in your data, this will give you a lot of confidence. A lot of traders will see that they're leaving money on the table, that they're closing winning trades too early, but they don't really know it. And they always have a feeling that there might be something wrong. But when you actually see it in your actual trading data, this will give you confidence to hold on to your winning trades longer. The next thing after you've been working on your trade management a little bit and you have start trusting your trades a little bit more, Smaller stop loss levels, surprisingly, also can make a big impact. So in Edgewonk, we have the feature what we call the exit analysis tool, and it shows you how is the price behaving and how close is the price coming towards your stop loss and your take profit levels. So we've been working with a trader lately, and we have seen that the trader is using very wide stop loss orders and the price almost never comes even close to the stop loss order. In that case, the wide stop loss levels are not necessary, and wider stop loss level can damage your reward to risk ratio. So I want to show you what this means. So assuming this is your regular approach, you have your entry, your stop loss, and your reward to and your take profit, and this gives you a 3-to-1 reward to risk ratio. And we have seen in a few traders now that the price on average doesn't really move a lot against them. There's only a small dip and then the price takes off. And the winning trades typically work right from the start. That's a really big insight, because if you are just manipulating your stop loss a little bit, you can see this is the initial stop loss here, and you are just moving your stop loss a little bit closer on your trades. It doesn't look like a lot, but your reward to risk ratio without changing the take profit jumps to 4.5 to 1. And this is a 50% increase in your reward to risk ratio. Suddenly, your winning trades are 50% larger than what they used to be when you're using your previous and your old stop loss approach. So this is something that cannot be overlooked. And if you find this in your trading data, this is going to be worth gold. So we have gotten the win rate up and we know how to get the win rate up. We've looked at how to improve winning trades. So just letting winning trades run and maybe even looking at stop loss orders if there's a lot of room. The next thing that we can focus on is how do we improve the trading strategy as a whole. And a trading strategy is more than just an entry. And there are a few ways how we can improve our trading strategy. The first thing is trade management. How do you deal with trade management? What we are seeing with a lot of traders is that when they're in a trade, they are quite clueless. They don't know how to deal with their trades once they're on. There's a lot of noise in the trading approach. Traders are also reacting very impulsively, moving stops, getting in, getting out of their trades, adding to the trade, taking off positions. But this is often done without a plan. And so by looking at first, what is your current approach? Do you even have an approach? And once you realize that you don't have a clear, consistent approach, there's so much room for improvement. So going through your last 20 to 30 trades and asking yourself for each trade, you can pull up an Excel file, a Word document, or a notepad. And for each trade, you write down what would have been the perfect trade management approach. Is it getting out? Is it moving the stop loss? Is it taking partial profits? Is it adding to a trade? And once you see that over 30, 40, 50 trades, you will probably see similarities and you will see themes in those findings that you have. And then once you see that one thing keeps coming up over and over again, you can then implement this new approach in your trade management. First of all, it will fix all of the inconsistencies. It will fix the guesswork. It will fix the impulsivity. It will also improve your confidence because now you exactly know what to do and what the best approach could be. Of course, there's still a chance that the first thing that you find is maybe not the perfect situation and the perfect rule set, but it's a start and you can start tweaking this over time, but at least now you have a solid foundation. The next thing is looking for alternative stop loss approaches. So we've already looked at if a stop loss is too far, maybe it's even too close, but you can test different approaches as well. For example, maybe a trailing stop loss works better, especially for trend following traders. So not capping your winning trades if you are a trend follower. Maybe even break-even stops are working for you. A lot of traders want to experiment with this and a lot of traders are unsure. And what then happens is that they are always using a different approach. On one trade, they are trailing the stop loss. On one trade, they're trading the stop loss in a different way. On some trades, they're using a break-even stop. Sometimes they're pulling in the stop slightly, sometimes more aggressively. And this is all creating noise in your trading. It's eroding your confidence. And this is not a professional way to approach this. In Edgewonk, to do all of those things here when it comes to improving your strategy, we have this feature called alternative strategies. And what you can do here is that You define a different trading approach. Maybe you want to test a stop loss for all of your trades. You go into your alternative strategies. You write down, I want to test a stop loss trailing approach. And then you go through your last 20 to 30 trades. And for each trade, you write down, would this trailing stop loss have improved my approach and my results? Or was there not an improvement? And this is a very quick and easy way to find better ways on how to approach your trades. Of course, you could also go through a back test. You say, okay, I want to test the trailing stop loss, and you do a full back test over an afternoon. But doing this in your actual trading data, in your Edgewonk trading journal with the alternative strategies, it's going to be a time saver. And it's actually going to show you the results based on your actual trades that you have taken in the past. So just going through your trades one by one and asking, would this stop loss approach perform better or worse? It will give you an answer within maybe an hour, maybe 30 minutes, depending on how many trades you're analyzing. But then again, you have the actual answer, and this is going to be way more helpful. And it's also going to give you way more confidence because now you know the actual data. And the last step also, instead of only looking at alternative stop loss, we can also look at alternative target approaches. So what are the ways on how we can set different take profit levels? We can test wider targets. For some traders, surprisingly, smaller targets might be the answer. We've been working with some traders who use take profit levels that are really, really far away, and they're just too optimistic with their target. And what we are seeing is that the price is moving in their favor, but because the target is so far away, the price will never reach the target and the price is turning around. And what we can then do is, if the target would have been a little bit closer to the entry, would this have been an improvement for your trading or not? And again, you do this in the alternative strategies in Edgewonk, and within a few minutes, maybe an hour, depending on how many trades you analyze, you go through your trades one by one and you say, okay, instead of a 4-to-1 reward to risk ratio, I'm going for a 3-to-1 or 2.5-to-1 reward to risk ratio. And I'm looking at every trade and see, is this an improvement, yes or no? And then again, you have the answer based on your actual trading data. You can trust the data, you can be confident, and step by step, you can then improve your trading strategy and slowly start tweaking your trading approach and hopefully nudge it into the right direction. And then the final step, which is a little bit more advanced, we can look at different risk management strategies, but you need to go through this process one at a time. The first thing is always fixing the win rate, fewer bad trades, more good trades, better processes. You want to look at how to improve your winning trades. You want to look at different ways how you can improve your strategy. And then we come to the advanced risk management. So one thing that we're working on with a trader right now is dynamic position sizing. So a lot of traders are using the 1% per trade position sizing rule. And this is totally fine, and it's the right way to go in the beginning. So having a fixed position size, whether it's 1%, 2%, 0.5%, 1/4%, that's going to give you a very solid foundation. Every trade is valued the same, and that is good in the beginning when you don't have the data to support any other approach. But the advanced approach is dynamic position sizing. And this means that you vary your position size trade on trade. On one trade, you might risk 1% or the other 2%. On the next one, 0.5%. But this needs to be done with a plan and with accurate data. Otherwise, you will ruin your trading performance. And the way to do this is you need to find the trades and the subset of your trades that have a higher win rate than the others. So typically, you want to look at what is my highest win rate subset in my trading data. What are my A+ trades that have a much higher win rate than the other ones? And then on those trades, you want to bet more. You want to increase your position size. But you need to first know the data. You need to be accurately able to identify the parts of your trading that have a higher win rate. And then you need to have a clear plan. How much are you going to risk on those trades? How do you find the high win rate trades in your system and in your trading? Typically, it is either one setup that performs much better than the other, or if you're trading just one setup, you want to look at what are the criteria that are present when those trades perform really, really well. In Edgewonk, you can easily tag your trades either based on the confluence factors that are present on the entry, or maybe you just give them an A+, B, or a C rating. But you really need to know what is the difference between an A, a B, and a C setup. You write down the different rules that are present for each A, B, and C setup. And then once you can identify a part of your trades where you maybe have a 65% win rate versus a 45 or 40% win rate, then you can start with experimenting with dynamic position sizing. But again, this is advanced. This is the last step after you've fixed all the other areas of your trading. And of course, risk management rules can also help you a lot. So daily loss limits, it's really important for day traders in particular. This can be either a percentage-based limit. So after you have occurred or realized 3, 4, 5% in a day, you stop trading for the day. Or you can also have drawdown rules based on historical data. For example, if you see that in the past, your largest drawdown or your largest losing streak is 6 losses in a row, once you hit that mark, you reduce your position size. So you maybe take half of your position size after you've hit your drawdown. This will help you remove a lot of the emotional pressures that come with being in a drawdown, and it's just going to help you trade a little bit more calm. And then once you start seeing that maybe the market has changed and the market phases are different now, and you are getting more winning trades, you can slowly scale up your position size as well. But those things need to be done with a lot of data. So you need to have a very well filled out trading journal, and you need to be able to very accurately identify those metrics in your trading journal. And this is then how you can improve your trading performance over time, step by step. Again, first, the win rate is the number one, making sure that you have good quality trades, that you're not breaking your rules. The problem is that when you suddenly start fixing or you start working on your bigger winning trades, and you haven't done the foundational work here in the win rate, you're still taking a lot of bad trades. And those bad trades are just noise in your trading. So trying to work on winning trades while you still have a lot of bad trades, when you're breaking your rules and you don't have good processes, it's going to wreck your trading and it's not going to have a big impact. So first, get the quality of your trades up, improve your processes, then try to working on your winning trades and improving your reward risk ratio, then looking at alternative approaches to improve the other aspects of your trading strategy, and then the last step, go into advanced risk management.